right, questions via email. Our first question came from Lloyd. Lloyd asked, there's 2 videos talk about rare situations which can be catastrophic and are easily avoided by closing spread positions before expiration or before a catastrophic event. We're typically referring to bull put credit spreads here. And this position here I've shown for GS, a small net credit of $11 on a 2.5 point spread. We sell a put out of the money. We buy a lower strike put. As long as the stock stays above both strike prices, all options expire worthless. That's the goal for the trade. But as we get closer to expiration, if the stock starts moving down towards our short put strike price, and we're worried that something may happen after hours, even after the close on Friday, and those are these catastrophic events he alluded to, what can we do? Now, I've left the links up here. I don't have the direct description of the 2 other services that posted these videos, but we're going to talk about the concepts there and my thoughts on those concepts as well. So let's jump right down to it. The first example, the video I believe was posted either by Robinhood or someone who was explaining a Robinhood transaction, was posted in August, but it did not give the exact date of this transaction. Essentially what happened is an investor entered a bull put spread into NKLA, NKLA. That's been volatile, but we'll show that also in a moment. After the close on Friday, NKLA had a sudden large drop. I think what they were saying is the investor thought the position was out of the money and was going to expire, meaning the stock was above the short put strike price and the position was going to expire. But what happened was that the sold put was assigned to him, which obligates us to buy shares of stock as it would in a cash secured naked put position. Still the same obligation in a bull put credit spread when we sell to open that initial put, even though buying to open the lower strike put gives us that leverage where you don't have to put up the full capital for the cash secured put, we're still in an obligation to potentially buy shares of stock. That is an outcome of a bull put credit spread. But in this case, that sudden drop where we thought it was out of the money, sold put was assigned, long expired. And this resulted in taking a higher max loss than expected. It's easier to explain in the second example because they didn't give the specifics of this one here. This is similar to a Tesla issue I think we talked about in June. Maybe it was July, I can't remember, but a similar situation happened after Friday close on Tesla where it dropped 40 or 50 points short moments after the market closed. Okay. All right, so that's the first example. The second example was on Biogen, BIIB. And I put a date there of Wednesday, November 4th, so it gave us a little wedding ring icon there. I apologize for that. I didn't have time to change all of these. This was Wednesday, November 4th. The stock had recently popped up 42% on the promise of an FDA announcement coming out in 2 days. So it was a Wednesday, I believe, and then the FDA result was expected on Friday. It came after hours. Well, after this 42% pop on that Wednesday or Thursday, an investor, when the stock was at 340, an investor apparently sold a 2-day out, 292.5, 290 bull put credit spread, selling the 292.5 strike, buying the 290, a 2.5 point spread. The stock halted prior to Friday's close and prior to the announcement. And then it fell hard to 230. Now, I wasn't clear on this because in this video that was shown by a different trading group, an options expert, options director of education like me, very intelligent and well-spoken gentleman, but the stock fell to 230, but they were showing a screenshot from Monday. So I don't know exactly how far it fell after hours in that case. It opened Monday at 230. But apparently with that after-hour drop, the short was exercised and the long wasn't, which means the investor was long 10,000 shares, did 100 contracts at the 292.5 strike on BIIB, with the stock now trading Monday at 230 when the market opened back up. All right, now take a look at each example. I'm sorry, I forgot to crop the dates in the picture here to show you, but this is sort of the August range that was shown for NKLA. We have a better slide later that shows a little bit better of what we think happened in this situation. And what do I mean by that? you see here, what color am I on? Let me make sure I've got a decent color for our drawings here. I think we want to go with the lighter green today. All right. I'm thinking that the video was posted on August 20th, and this was about August 4th or August 5th, right around here. I'm not sure if this is the gap they were talking about for Nikola. There's a more obvious one that was in earlier months. We're going to see that in a couple more slides. But in the video that they described, they were showing screenshots of the customer service replies to and from the customer, from Robinhood to the customer and back and forth. But some strange terminology was used. When this dropdown happened, they said the short option expiration was voided and then assigned, somewhere around 4:15 or 4:20, but the long still expired worthless. And this is a little bit different than the terminology that was used in the BIIB video that we'll talk about on BIIB video. But in the comments said, why wasn't the long exercised? And the reply was, the option buyer has the right to exercise, not the short seller. Well, the investor in a bull put credit spread is both. They are an option seller and an option buyer. So the question really was, how could the short be exercised by another option buyer and this investor could not exercise his? And there was no clarity on that. I guess the answer is it was exercised prior to 4 p.m. The investor wasn't notified prior to that. It couldn't expire worthless, but they said the fact that the expiration was voided and then assigned. I have never heard that terminology used before from a broker to a customer. If you guys have, let me know. I've never heard that term before, that the expiration was voided. Not saying it's shady. I'm not saying anything like that. I'm saying I personally have just never heard that terminology used in those situations. The second example, BIIB, it's a little bit different and maybe a little bit more obvious, but the short was exercised and the long was not. And this was coming down to the thing where here is the break. Here's that 42% gap I mentioned. You see it right there. And this was around November 4th. That's that 42% gap where it jumped from 240 up to 360 and then settled a little bit. The investor entered it somewhere in these 2 days with that large jump. Right, because the FDA announced they would be commenting on this drug on Friday. And that's why the stock moved in anticipation of some good news coming out. Maybe even that news release was favorable. And then the next day they're still in the trade. And then here's the Monday open that I mentioned, where I said it opens at about 2:30. I don't know what happened in the last 4 or 5, 10 minutes after 4 p.m. here to this particular stock. Was it between the strikes? And I mentioned this one was a 292.5, 290. Did it somehow fall to 291 at 410 or at 415? And they said, okay, at this point, the 490 is still out of the money. It expires. Oh, but you're in the money here, so it has to be assigned. When it was below both strike prices at 430. This one got even stranger. More strange, I should say, because the stock was halted prior to the close. And prior to the announcement, when it was above the strike prices, the investor thought, hey, I'm perfectly fine at my 290 strikes at this point, but the stock is halted in that case. We're right about here, right where that red arrow was. That's your 290 mark, in a sense. In the video, it said that the short was exercised during the halt. I don't know if anyone is explaining this well, because I don't see how myself as an option buyer can say, oh, the stock's halted. I want to exercise my 292.5 put right now. If I can do that, the other investor in the bull put credit spread should have been able to exercise their long at 290. I'm not clear. I'm sorry. I don't have the answer to the specifics here. I have the answer to Lloyd's question, but we want to go into more of the specifics here. The terminology that was being used was a little strange to me in some of these videos. I just didn't see how the other long option could exercise the short holder and we wouldn't be able to exercise our long if we wanted to during the halt. Nothing's supposed to happen during a halt. Nothing is supposed to happen in that situation where you're going to see a position where you can close it, where you should be able to exercise or assign it. It shouldn't happen. I'm sorry, you can't assign it, but be assigned or exercised, that should not happen. It should only happen once the market starts opening again, okay? In that case. So, anyway, these are the two examples that happened. These are the two catastrophic examples, and we have that reference to Tesla prior to that, where this happened sometime over the summer, where it had a large drop as well. All right, now, the impetus for Lloyd's question is obvious. And he says, can't we easily avoid these positions by closing early? Well, the answer is yes. But remember, this is still part of a trading plan. We're not trading spreads for the sake of trading spreads. We have a target in mind that we want to achieve on average. We have rules that we want to follow that we've discussed before here on the webinars. So you want to make sure that you're still able to hit your targets for the position. But yes, if you're concerned, if the stock's within a range, and usually my target is about 2% or so, if it's within 2% or so of my short put strike price going into expiration, and I can keep most of the profit that I expected, I will close out the position. Could these losses, one of them was a $600,000 loss, that 10,000 shares of, my apologies, the 10,000 shares of BIIB, purchased at $292.50 when the stock opened at $230. I think the broker automatically closed them out because they didn't have the capital to do it. So they took a $600,000 hit, I believe is what they said in the video, and the numbers look right there. I don't know what the exact loss was on NKLA or how that happened. But a more important question is, could these have been avoided altogether? Yes, and in my opinion, they should have been. In other words, I would have not entered these trades. And based on what you hear me say, you likely would not have either. In the different webinars, the different help videos that we have for bull put credit spreads and on power options, you likely wouldn't have entered either of these positions. Here's the better view sort of NKLA that I was referring to, a little bit better screenshot. As I mentioned, the video that was posted to us mentioned an August timeframe. Okay, so that's kind of in this area here. That was the screenshot I kind of showed you. But it's likely that the investor that mentioned it, that they discussed it on that video there, was due to this or due to this right here. What are the basic rules that you can see directly on our preferred weekly bull put credit spread search? And that you can also hear me talk about on a regular basis. Number one, I want the stock to be above the 20-day moving average. I want a positive MACD for 3 days minimum. And I'm not going to look for a stock that's, I'm not going to enter a stock that's recently lost 50% of its value. I bring that up because if this was the time frame that the investor got caught, that gap right there, 10, 11, even 20 days beforehand, this position should not have been entered. It was below the 20-day moving average, and the MACD started to go negative. I would never have entered a bull put credit spread with this stock in that time frame. But let's go back. Let's again say that the investor was here. Anywhere over in this time frame. Where are we? We're above the 20-day moving average. We're riding a positive MACD line. Everything looks good. But if I entered a trade here, clear that up again. If I had entered the trade here, it would have been for this expiration. Okay? I wouldn't go 60 days out in time. I wouldn't have gone 40 days out in time. This is, if I entered here, this is actually about 38 days. So I might have gone 30 days out in time, max. But you know me, normally I'm 11 to 14 days out in time. It wouldn't trigger it. Would I have entered it here? Not likely, because it's right at that cusp of going back to a negative MACD. Okay? Although it's still above the SMA 20, this would have been a warning sign for me. And I would not have entered the spread here, of course, or anywhere later until maybe here, in that case, which still had a disastrous fall, but that was much later in that case. And in this time frame also, I want to point out, if I was entering the spread here, and this was the gap that caught me, where are we? We're at about $51, $52, and it recently had gapped up to 90. In a 1 month period, a stock lost 50% of its value. I'm not hopping or hoping on the hot stock. Okay, it's got to match my desired sentiment, and it's got to match my goals for the trade. It's got to match that criteria. So NKLA, following the basic rules that we look at, I don't think you would have even entered this position, to tell you the truth. Okay, this is not to say that any position might not have an after hours fall, which is why we have that other rule that if we're in, close to that 1%, 1.5%, 2% of our short put strike price, we may look to close the position early to avoid that. But 3, 4, 5% is usually not an issue. This has never happened to me. These are issues Lloyd's concerned about getting into that position as well. Yeah, I see the questions still coming in. We're going to get to those after we go through this one and the next question that came in via email. So Pete, I do see your questions, and we'll talk about those criteria for that other strategy as well. Okay, of course, and get it to everyone else's questions too. So let's go on to the BIIB question. It stated that the trade was entered after a gap of 42%, and the FDA ruling was coming up in 2 days. So the position was entered here, trying to catch the hot stock and the hot movement, knowing with a little due diligence that an FDA announcement was coming up here. This is worse than earnings, honestly, folks. Knowing that you're in a biotech stock that has any type of FDA decision or ruling coming up on the date of your expiration or before your expiration is worse than entering knowing that earnings. We never trade a credit spread, iron condor, leverage spread position where we have an earnings date between now and expiration. Why? Because you see it. Because these are the events that happened. Was it above its SMA 20? Yeah, that gap pushed it above its SMA 20. Did it have a positive MACD? Yes, but not entirely for 3 days. Not entirely for 3 days. And the due diligence is key for any trade. Regardless if it comes up in the search, you still want to look at those news articles. You still want to have an understanding of what this stock is and what is coming up. They don't announce FDA approvals with a date and a time frame in the exchanges like they do with earnings, so we can see, oh, we're going to avoid the stock that has earnings or an ex-dividend date between now and expiration. Can't do that with these types of stocks. It's not a posted sort of data column, but you can find it, and it's not too hard. And with the BIIB position, what's another key factor? The most important factor, position sizing. A potential outcome of any bull put credit spread, because you are selling a put option, is that you may end up owning shares of stock. This spread was 100 contracts. They ended up buying 10,000 shares. It's 100 contracts selling a 292.5 and a 290. If the stock just even fell to 291, you're still buying 10,000 shares of stock at 292.50. If that's not your game plan, if you're not comfortable potentially owning the stock for long term, because this is a potential outcome, you shouldn't be using that type of volume and this type of strategy in the trade. Just like a cash secured put, we're going to talk about in a little bit for Pete after we get through some of our other questions that came in first. If you don't follow the hot stock, don't trade for the highest implied volatility. With a bull put credit spread, selling a cash secured put, naked put position where the outcome is you could potentially own shares of stock, only trade it against stocks that you would not mind owning for a potential long term, because that is a potential outcome of the trade. Going into a spread position, a bull put credit spread, does not negate that obligation. What it does is give you the benefit of leverage because you only have to cover the difference in the strike prices. Always remember that a potential outcome is that you may end up owning shares of stock. And these situations were catastrophic, don't get me wrong. I understand Lloyd's worry in these cases, but they are extraordinarily rare in those cases. Okay, these are 3 examples that I've seen just in the past year with all the hecticness that we've had. I haven't heard many other stories about these situations. They're coming into the limelight, and whether that's because investors are trading not having the full concept and the full risks explained to them is one thing. Whether the brokerages aren't explaining the risks of these positions and aren't monitoring the trade sizes well enough to keep investors out of trouble is another situation and another potential that could be true. I'm not trying to say that's the case, but you don't want to own 10,000 shares of Biogen. You shouldn't be trading 100 contracts in a bull put credit spread because that is a potential outcome of the position. Now, earlier on, I had mentioned GS. I had mentioned we'd see GS a little bit. I had some emails today with a customer, pertinent and timely discussion, who was trying to close a credit spread, bull put credit spread on Goldman Sachs prior to the close. The stock was at 289.01. The investor was at a 280 and I believe a 275 strike. It might have been 270. I'm sorry, it was 277.50. My apologies. And the debit to close was only 1 cent or 2 cents. It was a very normal bid-ask spread. It was about 4 cents on the midpoint for the 277.5 and 5 cents on the ask price of the 280 strike put around 1 o'clock, 2 o'clock, and 3 o'clock. The position hadn't been filled as we were talking. There was a lot of action on the 280 strike at 1:30 p.m., but the 277.5 had not gone since 12:45. And here is a snapshot of GS, of course. And you see here, well, what I did with these snapshots is from our quotes page. And here is our 2077.5 strike put, bid of 4, midpoint of 4, last price at 4, but it went through at 12:42. And this was at 1:30, as you can see over here. And this was a midpoint of 4 cents with an ask of 5, and the last price was at 5 cents. So putting in a sell to close at 3 and a buy to close at 5 for a 2 cent net credit on this position, I figured would have been filled easily. But you can see that even though there was action here, it had been 45 minutes since there had been any closing action on the 277.5 put strike. But I figure that close at 1 or 2 cents would have been golden for Goldman Sachs. Later on, of course, did see the prices update and did see the prices fill. And I think that position was closed for that 1 cent debit. My battle today was with HUM. This was a little bit different. As I was going through the presentation, as I was getting the slides together for today's presentation, I'm monitoring this one. This had a net credit of 165, 15.2% potential return at expiration, but the stock was at 408. I'm holding the 405, 402.5. All right, less than 1% out of the money. That's why I'm trying to close it. Early in the day, the activity on this position, the 405, was closed at 9:44. Okay, this was, I was doing this around 2:45, 3 o'clock. It hadn't seen any action since 9:44, and the last price was 70, but they're posting a midpoint of 10 cents with a bid of 5 and an ask of 15. Had I taken the 70 cents and closed this, sold to close this at 45, if I got that midpoint with what? Bid of 0, ask of 90. Ugh. This would have been a 25-cent debit to close between 70 and 45, which means this is 5 contracts. The 165 credit is 5 contracts in that case at a 33-cent net credit. So closing at a 25-cent debit would have only given me an 8-cent credit. That would have not met my goals. I was able to close this position. I didn't get the updated highlight screenshot. I was able to close my short 405 for 5 cents at 310. I left the long open. Okay, it's not going to drop below that. I'm not going to end up being short shares of stock for that obligation at 402.50 in that case. So here's sort of the point. I missed my target. My target's around 14.5, 14.9%. By paying that extra 5 cents, so Humana doesn't drop below my 405 strike after the close, I'm only getting a 12.6% return on this, one of my 3 bull put credit spreads for this cycle. The other 2 I didn't even have to worry about. But that is important because it goes to some of the closing issues and the targets. And what do I mean by that? It's never a bad idea to close the position early if you're still able to make 80 to 90% of what you expected on the trade. If you're worried about assignment, of course, you can close early, specifically the short. You can maybe leave the long open, but you particularly want to close the short. That causes you to buy. Would I ever do a bull put credit spread going into expiration in these situations? where I sold to close the long put and left the short open? The answer is no, because now I have no protection in case of these unexpected gaps, which again, I've only heard it happen on 3 stocks in the last year, maybe 4 stocks in the last 5 years. It's not a common occurrence. And being halted right before the close on a Friday is something I don't think I've ever seen before. And I personally mentioned it already. I'd be avoiding that situation. Okay. You've heard me talk about it. You've heard Sam talk about it when he joins us for these webinars over the years. You've heard others talk about it. Proper position sizing is key. Just following the hot stock for a good volatility bull put credit spread, which may or may not even had the right probability and right range out of the money to begin with. Someone's just tracking that 42% gap and looking for that enriched premium because of this event that's coming out in 2 days, which caused the problem. All right. Don't put yourself in a position that you can't handle. Your outcome is still you may potentially have to buy shares of stock at that price. Don't overtrade. Don't follow the hot stock. Follow the proper guidelines for a good, reasonable bull put spread. Okay. If you are worried about these 3 examples, of course, 2 of which you likely would not have gotten into, and I showed the reasons why. If you're following the proper structure and a proper trading plan for these types of spread positions, you likely wouldn't even have entered NKLA or BIIB to begin with. But if you're still worried about it, these things have happened. I'm not saying they're wrong. I'm not saying these are false statements. They happened and they're real. But if you're concerned about that and you're concerned that you're having too many contracts open, you're concerned about this risk, honestly, maybe it's time to evaluate other strategies. Find something that doesn't have that potential of you being assigned for an after hours movement, which again, I've seen these examples. I've seen these webinars. We talked about Tesla a couple months ago when that happened, and that was posted as well. These scenarios. You can close early, but still make sure you're hitting your targets as best as possible. But if you're worried about it, maybe evaluate a strategy that's a little bit safer.